Welcome back to another episode of Financial Accounting. In this video, we are going to talk about Advanced Financial Accounting, Consolidated Financial Statements. Here, to cover up the session, I'm going to refer your tutorial. In the tutorial, you have given two companies, King and Queen, and they have provided the Statement of Comprehensive Income for the year ended 31st March 2021. As well as they have provided the Statement of Financial Position as at 31st March 2021. Now let's refer the additional information. On 1st of April 2018, King plc acquired 60 million ordinary shares out of 80 million ordinary shares of Queen plc for cash consideration of 90 million. You know this cash consideration is the investment which King plc invested upon the Queen plc. Queen Limited retained earnings stood at 20 million at the date of acquisition. There were not any changes to the stated capital of Queen plc since the date of acquisition, which means the capital invested in the Queen plc is stated as 80 million of that. Other reserves belong to the post-acquisition, which means 20 million is the pre-acquisition and the balance is the post-acquisition reserves. Now let's see how we are going to refer this information. Based on the other additional information number 1, we are going to calculate the ownership. Here on 1st of April 2018, the acquisition has been made and they have invested 60 million ordinary shares out of the 80 million, which means King plc have 75% ownership over the Queen plc assets and liabilities. Based on the given information, let's do the equity analysis of the Queen plc. As they mentioned, on 1st of April 2018, the stated capital remained as 40,000 and retained earnings are 20,000. Here I am referring everything in thousands. That's why I have mentioned 40 million and 20 million in 40,000 and 20,000. Then, in the current financial period or at the end of 31st March 2021, even the stated capital remained as 40,000, retained earnings or our reserves has been increased to 55,000, which means the post-acquisition reserve is 35,000. Now, out of the pre-acquisition reserves on 1st of April 2018, 75% should be goes to the cost of control in order to calculate goodwill, and 75% of the remaining has to be transferred to the non-controlling interest account. Then the balance of the post-acquisition reserve goes to 75% to the consolidated reserve and 25% goes to the non-controlling interest. Rather than doing it in twice or thrice, what we can do is first, the pre-acquisition reserves, we can transfer 75% to the cost of control account to calculate the goodwill. Then, from the post-acquisition reserves, we can transfer the King's share of 75% to the consolidated reserves, and the ending balance of 31st March 2021, 25% of that we can transfer to the non-controlling interest. Then it will ease our work. Now let's transfer the other data into the consolidated reserve. Here we can get the retained earnings as the general reserve and we can put it into the consolidated reserves. If not, you can put it as consolidated retained earnings as well. Based on that, now we are going to calculate the consolidated reserves. First, in the consolidated retained earnings or the reserve, we have to put the parent or the king's reserves. That is 145,000. Then we have to put the post-acquisition reserves of the King PLC. Here it is 26,250. That is calculated by 75% of the 35,000. That is the post-acquisition reserve. Then we are going to calculate the non-controlling interest. For that, we have to put the share ownership of the non-controlling interest. That is 25% of 40,000, which is 10,000. And the retained earnings, that is calculated by, we know that at the end of the period, we have 55,000. Out of that, 25% goes to non-controlling interest. Therefore, that is 13,750. The second additional information is the group policy is to measure the non-controlling interest at fair value. When non-controlling interest is measured at its fair value, the implications are there. There is a part of goodwill which is attributable to non-controlling interest, and the subsequent impairment loss of goodwill must also be applied against the non-controlling interest. Therefore, when there is an impairment, it is impacted on the non-controlling interest as well. And in this question, it says, fair value of non-controlling interest of Queen was estimated to rupees 40 million at the date of acquisition. In the third additional information, they have provided that fair value of net identifiable assets of Queen PLC as at 1st of April 2018 was 90 million. And the remaining excess in fair value is attributable to property, plant and equipment. Based on the part 3 of the information, let's calculate the net assets. Net assets can be calculated by the given accounting equation. Here, it indicates asset is the total of equity plus liability, which means the net assets is all the assets minus liability. Therefore, net assets is always equal to the equity. In this company, equity is 40,000 of stated capital and 20,000 of the retained earnings as at 1st of April 2018. Therefore, the equity balance is 60,000. Now it says the fair value is greater than the net asset, which means the fair value is 90,000 and it's greater than the net assets. So you can see there is an upward revaluation. So what we can do is we can debit the property, plant and equipment by 30,000 and we can transfer it to the revaluation reserve by 30,000. Now from the revaluation reserve 30,000 is transferred to the cost of control account in order to calculate the goodwill. According to the goodwill calculation under SLFRS 3, there are two methods. One way is to calculate goodwill based on the fair value. The other way is calculate the goodwill based on the proportionate share of acquirees' identifiable net assets. In this question, they specifically mention that you have to calculate goodwill based on the fair value. Accordingly, goodwill on consolidation can be calculated as follows. First, we have to take the fair value of the consideration, that is 90 million. Then for that we have to add the amount of non-controlling interest, that is 40 million. Here also we have to take the fair value. Then both add up to 130 million. From that we have to deduct the fair value of identifiable net assets. Here under third additional information, they have provided that the fair value of the identifiable net assets is equal to 90 million. Then we can calculate the goodwill on the acquisition date as 40 million. After calculating the goodwill, it has to be attributable among non-controlling interest and parent. Goodwill attributable to non-controlling interest can be calculated by fair value of the non-controlling interest minus the fair value of the non-controlling interest proportionate share of the net assets. Then the balance is transferred to the parent. Goodwill attributable to non-controlling interest is 17,500. That is the fair value of non-controlling interest 40,000 minus the proportionate share of the net asset, that is 90,000 into 25%. Then the balance is transferred to the parent, that is 22,500. Now let's see the impact on the consolidated retained earnings and non-controlling interest. When it comes to consolidated retained earnings, first we have to take the King's PLC retained earnings. For that, we have to add up the post-acquisition retained earnings share of King PLC. Therefore, we have to take Queen PLC's post-acquisition reserves of 35,000 and we have to take the ownership holding of 75%. So we are getting 26,250. Altogether, the consolidated retained earnings will be 171,250. When it comes to non-controlling interest, first we are going to take the capital portion. So out of the 40,000 capital, the non-controlling interest will be 25%, which means the capital will be 10,000. For that, we have to add the retained earnings. So here, at the end of the balance sheet, retained earnings, we have to take 25%, which is 13,750. For that, we have to add up the fair value adjustment. So, the fair value adjustment is 30,000 of the additional fair value into 25%, which means 7,500. Now you can see at the end of the balance sheet, we are going to take 25% of each capital, retained earnings and fair value adjustment. Now, not only this, we have to take the goodwill component which is relating to the non-controlling interest. So from the goodwill, we have to take the non-controlling interest portion of 17,500. Then at the end of the balance sheet date, non-controlling interest will be 48,750. Now let's look at the statement of financial position as at 31st March 2021 after the first three adjustments. So here first, as you can remember, we have to calculate the goodwill. Therefore, we have to transfer the investment in Queen Limited. So we are going to remove this 90,000. Then stated capital should always transfer. So you can remember that 75% is belong to king, which means 30,000, and 10,000 is belong to the non-controlling interest, which is 25%. Then retained earnings, they stated that 20,000 is the pre-acquisition reserves. Now, in the question stated that the fair value of the net asset is 90,000. So, when we are adding back the book value of the net asset, you can see there is a 30,000 increment. Therefore, we are going to add it back to property, plant and equipment, and we are going to transfer it to the fair value adjustment account. Then, based on these calculations, we are going to calculate the goodwill. So, the goodwill is 40,000. Now, we have to calculate the non-controlling interest. So, in the non-controlling interest, first we have to transfer the 10,000 of the stated capital. Then, from the retained earnings, we have to take 25%, which means 55,000 into 25%. Then, fair value adjustment, 75% goes to the owners, which is King PLC, and the balance of 7,500 belongs to the non-controlling interest. When we transfer these values as well as the portion of goodwill, the non-controlling interest value will be 48,750. At the end of these transactions, the property, plant and equipment balance will be 410,000. There won't be any investment account. Goodwill will be 40,000. Then in the stated capital, we can just see the King's PLC's stated capital. Then retained earnings account, we can see the King PLC's retained earnings plus 75% of the post-acquisition reserves. Then the fair value adjustment account, we don't have a balance. And in the non-controlling account, interest account, we can see first three transactions referring to the goodwill calculation. Therefore, there is no impact on the consolidated income statement. Now let's look at the fourth transaction. It says King PLC has sold goods to Queen PLC. The invoice price amount to rupees 8 million. Goods are sold, right, based on the cost plus 25%, which means when the cost is 100, the profit will be 25%. So the selling price is 125%. Queen PLC was not able to sell 25% of the goods purchased from King's PLC. So you can see there are unsold stocks, right? So in the unsold stocks, that is 25% of 8 million, which is 2 million. Now we have to recognize the cost value of the stock, which is 2 into 100 divided by 125. So the cost is, in this question, 1.6 million. Then in the unrealized profit, we have to take 2 million into 25 divided by 125. So the unrealized profit is 0.4 million. Now you can remember in this question, we have taken all the values in thousands. Therefore, we have to convert these values into thousand in order to calculate the statement of financial position. Therefore, due to the unrealized profit, the retained profit should be debit by 4,000 and inventory value should be deducted by 4,000. Earlier, we have calculated it in millions. Now, in this one, we have converted into rupees 1000. Now, from the inventory, we have to remove this unrealized profit of 4000. Then, the inventory value will be 41,000 of king plus 25,000 of queen, and we have to remove this 4,000. So, the inventory value would be 62,000. Now, from the retained earnings, other than the earlier adjustments, we have to remove this unrealized profit of 4,000. Then the ultimate retained earnings balance will be 167,250. Now let's see the impact of this intercompany trading on the consolidated statement of comprehensive income. First, what we are going to do is we are going to remove this intercompany trading of 8 million. Since this is in rupees thousands, we are going to remove 8,000 from the revenue and we are going to add it back to the cost of sales. Now, due to this transaction, we have 4,000 of unrealized profit. What we are going to do is we are going to remove that 4,000 from the gross profit. And we know that this is embedded in the cost of sales under closing stock. So what we are going to remove is we are going to remove that additional 4,000 of the unrealized profit from the inventory. Therefore, we are going to deduct 4,000 from the cost of sales. After this transaction, the revenue figure would be 772,000 and cost of sales will be 419,000 and gross profit figure will be 353,000. Please check whether you are getting the accurate figure. After preparing the income statement, what we are going to do is we are going to prepare the comprehensive income statement. So here, from the profit after tax, we have to see how much we are going to attribute for non-controlling interest and how much we are going to attributable for parent interest. So here, to calculate the non-controlling interest, what we are going to do is we are going to take the Queen PLC's profit and from that we have to deduct 4,000, which is the unrealized profit from the stocks. Then out of that profit we have to take 25% which is belong to non-controlling interest. Therefore, the balance would be 2,250. After that, what we are going to do is we are going to see how much of the profit from the comprehensive income we are going to attributable for the non-controlling interest. Therefore, we are going to take the total comprehensive income of Queen, which is 28,000. From that, we are going to deduct the unrealized profit of 4,000. Out of that, we are going to take 25% which belongs to the non-controlling interest. Therefore, the balance is 6,000. It says Queen sold machinery on 1st of April 2020 for 5 million to King PLC. So now this had a carrying amount of 4 million in Queen's PLC books as at that date. The remaining useful life of the asset at the date of disposal was 4 years. So here we know that when Queen sold stocks or inventory to the King PLC, we have to calculate the unrealized profit. So here we are going to calculate unrealized profit in thousands. So the carrying amount at the reporting date is stated as 4 million. For that, we have to deduct the carrying value at the reporting date if the intergroup transaction had not occurred. So, you know, this asset brought at 1st of April 2020. Now, The current financial period is ending at 31st March 2021, which means we have to depreciate this asset just for 1 year. Because we have to calculate the depreciation, the normal depreciation, if this transaction had not occurred. So, we know based on the straight line principle, we can calculate the depreciation. For that, we have to divide the asset by its useful life. So here 5 million is the asset value. Since we are going to calculate it in thousands, we are going to put 5,000. Then the useful life is 4 years. Therefore, per year it will depreciated by 1,250. Since it has been depreciated just 1 year, what we are going to do, from the 5,000 we are going to deduct 1,250. Therefore, the value would be 3,750. Now, the unrealized profit in this transaction is just 250. That is the difference between carrying amount at the reporting date and carrying amount if the transaction had not occurred. Then, let's see how we are going to treat this unrealized profit in non-current assets. So first what we are going to do, we are going to remove it from the group retained earnings. Here we have to remove just the King's portion. Therefore, we have to take 25% of 250, which is 187 and 50 cents. Then we have to remove it from the non-controlling interest. So, 250 into 25% should be taken, which is 62 rupees and 50 cents. Then, the total unrealized profit should be removed from the non-current asset. In this question, property, plant and equipment, which is 250. Now what we are going to do is we are going to remove this unrealized profit from the property, plant and equipment. So the new balance will be 409,750. Then the King's share we have to remove from the retained earnings, that is 187 and 57. So the balance is 167,062 rupees and 50 cents. Then we have to remove the share from the non-controlling interest, which is 62 rupees and 50 cents. So the new balance of the non-controlling interest be 48,687 and 50 cents. Unrealized profit by selling the non-current assets should be removed from the other income. Therefore, we are going to remove 250 from the other income. The balance of the other income is 38,750. Now what we are going to do, we are going to calculate the total comprehensive income. From that, we are going to start with the profit after tax. Now we have to see how much of the profit after tax is attributable for the non-controlling interest. Earlier we know that we have to take the Queen PLC's profit. From that we have to remove all the unrealized profit. Here 4,000 reflect the unrealized profit from the stocks and 250 reflect the unrealized profit from non-current asset disposal. Then the remaining profit we have to take 25%, which is 2,187 rupees and 50 cents. Then in the other comprehensive income, we are going to take the total. This other comprehensive income can be the gain on translation of foreign operations, or it can be a gain on retirement benefit plan. what we are going to do, since we are going to do consolidation, we are going to add them together. So we are getting 25,000. Now next step is, from the total comprehensive income, we have to calculate which is attributable for non-controlling interest. For that, we are going to take the total comprehensive of Queen. From that, we are going to remove all the unrealized profit. So the remaining balance, we are going to take 25%. So the total comprehensive income which is attributable for non-controlling interest is 5,937 rupees and 50 cents. Now let's look at the sixth adjustment. It says that the difference between the current accounts are due to cash in transit. So let's look at the balances between the current accounts. Under King, it says that current account with Q Limited 8,500, and under Queen Limited it says that current account with King Limited 5,000. So when we are going to set off these three, you can see there is a balance of 3,500. So this is the cash in transit and it goes to the King's Limited. Let's see how we are going to incorporate the sixth adjustment into the statement of financial position. So here under current assets, we have current accounts with Queen Limited in King's Limited account, and under current liabilities of Queen Limited, we have current account with King Limited. So first one is we have to identify the lesser value. Here the lesser value is 5,000. So this 5,000 should be removed from the current liabilities of Queen, and we have to set off against the current account with Queen Limited in the Kings. Therefore, when we remove these values, you can see we are removing all the current liabilities from the financial statements. At the same time, under the current assets, we have a balance of 3,500. That is 8,500 minus 5,000. This is recognized as the cash in transit. Cash in transit is a current asset. So we are going to put it into the group under cash in transit. The value is 3,500. Due to the above transaction, there is no impact on the comprehensive income statement. Here the final adjustment is the impairment test. So here impairment test carried out on 31st of March 2021 and it include an impairment loss of 5 million. So what we are going to do is, since this is an expense, we are going to debit the income statement by 5,000 and we are going to credit the goodwill by 5,000. Now impairment 5,000 should be removed from the goodwill and the new goodwill balance will be 35,000. And it should be always removed from the retained earnings and the current retained balance will be 162,062 rupees and 50 cents. Impairment loss should be recognized under the administrative expense. Therefore, we are going to put 5,000 under administrative expense and as a result, the total administrative expense in the group will be increased to 111,000. Now let's see profit after tax attributable for non-controlling interest as a result of the impairment. Now here from the Queen's PLC 13,000 we have removed the unrealized profit of 4,000 of inventory and unrealized profit of 250 of non-current asset disposal. Now from that value we are going to deduct 5,000 of the impairment loss. Now from the remaining balance we have to take 25% which is belong to non-controlling interest. Therefore the balance would be 937 rupees and 50 cents. Now then we are going to take the comprehensive income of king and queen, which is 25,000. Now from the total comprehensive income, we have to see how much we can attributable for non-controlling interest. For that, we are going to take Queen PLC's 28,000. From that, we are going to deduct all the unrealized profits. Then we are going to deduct the impairment loss. From that, from the remaining balance, we are going to take 25%. Therefore, the balance is 4,687 rupees and 50 cents. Now you can see the consolidated statement of financial position as at 31st March 2021. Now in this one you can see all the adjustments which is relating to the statement of comprehensive income and how you can incorporate it into the consolidated statement of comprehensive income. Hope you have gained some knowledge with regarding the consolidation process as well as how we are going to treat the adjustments which is relating to the consolidation. Stay tuned with my next video. In my next video, I am going to incorporate some more adjustments which is related to the consolidation.